Hello and welcome to Hedge Fund Tips with Tom Hayes for the week ending November 13th, 2020, Friday the 13th of all days. And this is our 56th VideoCast and 46th podcast, so welcome along. We've got a good amount to cover tonight, but what a great week it's been. Everything we've been talking about in the last couple of months has come to pass, so very, very good things to discuss for sure. So, first order that we always do is we're going to cover the media spots. First, I'd like to thank Ellie Terrett and Liz Clayman for having me on the Clayman Countdown on Wednesday. And the key things that we discussed in this segment were the Goldman Sachs upgrade for the end of the year S&P price target. They pushed it from 3,600 to 3,700. They pushed 2021 to 4,300, which would be a 16% gain from end of year, and then 2022 to 4,600. And this was on the backs of the Pfizer vaccine data, the phase 3 data showing 90% plus efficacy. This was a huge catalyst we've been waiting for the rotation into the cyclicals trade, and boy, was it ever a rotation in this past week. I'm going to show you some numbers in a little bit. The other aspect that's positive that I think can help their estimates play out is that the gridlock government outcome was the most positive outcome historically for the last 100 years, and particularly because that leaves the corporate tax rate at 21%, so we won't have that $20 loss of S&P earnings. So that is a big deal. Obviously, that hinges on the Georgia runoff, which looks very positive, but that's where it is right now. And furthermore, we have the Moderna data coming out, and could be potentially on Monday at the rate things are going with the timelines that they've been given. And finally, we had the Eli Lilly treatment cocktail, which is basically very similar to the Regeneron cocktail that the president took that helped him very quickly. That received emergency use authorization this week. So those are some of the key factors that'll play into Goldman hitting the targets that they've laid out. We are in a new business cycle. We've just gotten through the recession. We had 2 negative quarters of GDP growth. Followed by Q3 was positive, and the unemployment rate has come down from 14.1 to 6.9. We also talked about, well, where is the contributor to this increased earnings, because David Kostin's premise was based on a 2020 earnings estimate of $175, which is higher than consensus, which is right now at $168, which is also interesting because we've seen in the last 8 weeks earnings estimates have been going up every single week into the end of the year, which is not always the case. Usually as you get closer to the event, the earnings trend down a little bit to set expectations. Earnings continue to climb. They were 163, now they're 168. Kostin's calling for 175. I even saw Paulson out this week. He's a strategist from the Midwest, I think the Luthold Group. He was talking $200, and I don't think that's out of the question. So very positive things. But where are the earnings going to come from? And I think the earnings are going to come from banks. The 4 money center banks are over reserved by about $20 to $25 billion. They took those huge reserves in Q2 on the basis of number one, expectations at the time were that unemployment could go over 20%. Instead, it's now at 6.9%. And also the CECL, the change in the paper change in the accounting standards that required them to take 100% of expected worst case scenario all up front. We've come nowhere near the worst case scenario, number one. And number two, due to Operation Warp Speed and the acceleration of this vaccine, it's just staggering to get it done. You know, the second fastest vaccine ever in history, I believe, was 4 to 5 years. Meg Terrell was talking today. I think it was actually about just over 4 years to develop. And if you think about HIV/AIDS, which Dr. Fauci presided over, they were never able to come up with a vaccine, and 30 million people unfortunately died. So it's just amazing to see this, and I'm sure Dr. Fauci was out very happy with the news this week as well, having seen all that he's seen over decades. He said help is coming, and he believes that we're going to be able to have vaccines for everyone by April, which is pretty exciting, and many, many people before the end of the year. So I'm sure that made him happy, and it certainly made the whole country happy, and it made the stock market happy. So that this was a good thing. The other aspect is, if you recall, on the Friday before the election, the market was absolutely plummeting. I was on Liz's show, and what was happening was tech stocks were getting battered, and I said, this is not a liquidation. I think the Dow was down 900 some odd points minutes before I went on. I said, this is a rotation. It's not a liquidation, and that proved to be prescient. The four stocks I talked about on that show were Raytheon and GE, and Bank of America and Wells Fargo. Since then, I think Raytheon and GE are now up close to 30%, almost over 25%, and Bank of America and Wells Fargo are up somewhere in the neighborhood of 15 to 20% off of those lows. And that's exactly what's happening, and that was dramatically accelerated this week. The other aspects with regard to the Goldman Outlook that I view as very important related to that is that generally the first 8 quarters of a new business cycle, which we've just started, cyclicals outperform relative to tech and growth. And the first 6 months after a presidential election, the same is true. That's going to really help the economically sensitive stocks. You're coming off a very low baseline, so as we have 5 to 6% GDP growth in the coming year due to an increase of money supply of about 24-25% year on year, these stocks are going to hum. And they started that jump start off the line in earnest this week. The upward earnings revisions are a key component. You'll have, in the case of the big four money center banks, about $25 billion of reserves released over the next probably 8 quarters. That all comes back as earnings power. And I believe there's over $110 billion of reserves taken for the whole banking sector in Q2. Much of that is not estimated in the 2021 earnings. And financials still make up a reasonable weight in the S&P, and that will be very, very promising. That's number one. Number two, the net interest margin, the yield curve is steepening. That's also not in the 2021 earnings for banks, and it's starting to happen pretty precipitously this week, and we'll take a look at that on this podcast and videocast. The other factor that's going to help earnings and make these estimates a reality, in my view, is the Boeing ungrounding of the 737 MAX. That's a big weight that could have a huge impact on overall earnings for the S&P 500 as that's ungrounded. That could add a nice slug, and that's where we start to get up to Costin's $175 and maybe even Paulson's $200, which may be a little aggressive, but you add a 20 multiple on that. That certainly puts you in the league of what Costin's talking about, of 4,300 by the end of 2021, and that's that. So moving on Tuesday, I was on the CGTN Global Business with Rochelle Akufo. I want to thank Rochelle and Stephanie Savage for having me on Tuesday. And the reason I pay a lot of attention to the China data, as we've said in past podcasts, is they're about 2 to 3 months ahead of us in the recovery on the data. We've been following that roadmap pretty closely. And I was asked to talk about the inflation numbers. Their inflation numbers were actually lower than expected, but that was a one-off due to their hog prices coming down for the first time since February of 2019. It was the lowest inflation rate since 2009, so over a decade. They had a swine flu with their hogs, and they also had flooding that increased the cost of transportation. Both of those have subsided. So both the PPI producer price index and the consumer price index were low due to anything food related, and also energy and oil was very low last month. That's starting to change pretty quickly. So that was a positive trend to see. Their money supply continues to grow. Their M2 was up 10.9% in October versus 10.4% estimates. Their loan growth was up 13%. Retail sales, they just started to come out of the woodworks, was plus 3.3% in October. They had been negative all the way through August. September was the first print at 0.5%, I believe it was. Their unemployment rate's now down to 5.4%. And all their PMIs are in expansionary territory, particularly their non-manufacturing is up to 56.2. Their exports are humming at 11.4, which shows global demand coming back. Their imports have been weak, and I think that's going to change if the trade climate changes in coming months. And the other thing that I thought was very interesting, their shutdown was Q1, ours was Q2. So in Q1, they were at negative 6.8% GDP. Q2, they came in at plus 3.2. That was when their factories started humming. And Q3 was when their consumers started humming, and they hit 4.9% GDP. In our case, we were shut down in Q2. So Q3 was when things started to wake up, and I think Q4 we'll see even better things. Now, we do have a little bit of headwind with the cases spiking up due to the winter and some of the different regions getting hit harder that had not been hit as hard originally. But I think the market can look through that because of all the good news on the treatment and vaccine front. The death rate has absolutely plummeted. Yes, it's a lagging indicator, but the treatments are phenomenal now that we have Lilly, and I believe they're going to have a few 100,000 of the Lilly drugs out in circulation, if I remember correctly from the press conference this afternoon regarding warp speed. It was just after the close, something like 500,000 of the 500,000 of the Lilly ship. They'll be free for people who are in severe situations. So the people going in the hospital, 500,000 will get the Lilly. They'll probably get results like President Trump got, or better if they're younger and in better condition, etc. And it worked for him right away. So that's very positive to see. Remdesivir, they've got enough for 850,000 patients, more on the way. And they're going to have tens of millions of doses of the vaccines before the end of the year. If you recall, they've been producing them at loss before approval. So they were producing them for many months. And if it wasn't approved, they were just going to get thrown out and the government would have eaten the loss, or the taxpayers would have eaten the loss. But since they are approved, they'll be ready. That's 50 million. That's quite a lot. And then it's expected 1.5 billion by next year doses around the world. So this is over. So we really just have to get through the next few months until there are enough treatments and vaccines to go around. But I think the market can look through a few months now that the solution is in sight. So very positive things on that front. The other thing is this data that's coming out of China, which is really interesting, is with no vaccine. So and all they had in terms of treatment, as far as we know, is the remdesivir, and I'm not sure to what scale that they're using it at, but they are last month, their National Day holiday, their domestic air travel was actually higher than the same holiday in 2019. So they're more than back to normal. Their hotel bookings were higher than 2019, again, more than back to normal pre-pandemic levels. And their fast food levels, as you're seeing from some of the U.S. companies that have fast food operations in China, as well as their own domestic, they're near normal levels. And the other thing is their movie box offices, which is phenomenal. They're limited to 75% capacity, and yet they still had their second highest receipts in history during their National Day holiday, which is phenomenal. Sounds like a lot of popcorn to me. So that's what we have to look forward to. That's without the vaccine. With the vaccine, I think that the pent-up growth and global demand is going to be off the charts. So that was really good news. So again, thanks to Ellie and Liz at Fox, Ellie Terrett and Liz Clayman, and thanks to Rochelle Akufo and Stephanie Savage over at CGT and Global Business. On Monday, Meta Singh and Shivani Kumarasan called me from Reuters. Thanks for including me in your article. This was on the back of the Pfizer news. What a great time that was. And my quote was, "The vaccine effectiveness has far exceeded even the wildest of optimistic expectations, and the market is reflecting that," said Tom Hayes. "This is getting to the end of the crisis and is a game changer, and that's for sure. And yes, we have to wear our masks and social distance in public and do all of the things for the next, couple of months until the distribution takes place and everything, and the cases come down and the hospital capacity is back to normal levels. But it's going to be sooner than we all expect." So very, very good news on that front. Now, this, I could show you this table and say nothing else for the rest of the podcast VideoCast, because this basically tells the whole story. This is from Sarah Ponczek over at Bloomberg. You should look on Twitter. She posts a lot of good stuff. Ponczek. Follow her on Twitter. And this was the return by sector for this week. Absolutely phenomenal, these numbers. We've been talking about this for weeks and weeks, and it's finally come true. So energy was energy was number one, up 16.32% for the week. Again, we said over and over, don't bet against science. The catalyst for the rotation into cyclicals will be when we have a vaccine, and it couldn't be to the minute we had the vaccine. So energy up 16.32% this week. I believe it's its best week in history as a sector, and we have some data we'll talk about in a minute that I think supports that. Financials was number two, up 8.2% for the week. Absolutely amazing. Industrials were up 5%, and this is what we've been talking about over and over and over again. Financials, industrials, and energy, and they've just absolutely, gold, silver, bronze. And that was right after the vaccine. So very good to see. That's just the Pfizer vaccine, the Lilly article, Dr. Fauci saying help is coming, which we covered. Now let's talk about momentum versus value, or growth versus value. Momentum had its worst day versus value in decades on Monday once they announced the vaccine, and everyone ran for the crowded exit in the Momo stocks. It was in over 25 years, never has momentum had that bad of an experience relative to value. So far, this was through Thursday, this chart. Value stocks were on track for their best week against growth since 2001. If you remember, 2001 was when the baton shifted from, there were a handful of stocks, tech stocks, 5 or so stocks that made up 25% of the weight of the S&P 500. Back to the future, we have 5 stocks that are making up even greater weight right now, and from 2001 to 2006, value had one of its best runs ever, and I think we're on the cusp of that right now. So, and it's due to a lot of factors. Number one, the steepening of the yield curve, the banks, the new expansion, and I think also energy, which we covered last week. Assuming that the political outcome is as expected, I think OPEC is going to have more muscle to flex as demand comes back. I think you're going to see an oil environment that's more similar to the period under the Obama administration when regulations were higher. It was tougher to drill and prices were through the roof. So we should be looking forward to $3 to $4 at the tank, probably 12 to 24 months out. It could certainly be sooner if demand picks back up and air travel picks back up due to the vaccine. But one of the things that President Trump ran on and implemented was he was very aggressive with OPEC even before demand destruction from COVID, in them keeping their production up so that prices would remain low at the pump. And I think that's going to be all in the rearview mirror, which is very, very good for the energy sector. So the major players, the marginal players will be toast, but the major players will gain more and more share. And even on the most optimistic basis of renewables leading the way a couple decades down the road and taking over, the runoff value of these companies is just phenomenal. And I think there's going to be much more to it than a runoff value moving forward. So very, very excited to see this development. This shows how since 1926, this is from the Wall Street Journal, this was value versus growth. Basically, through all time, the value premium since, I believe, 1901 is about 3% per year. It's outperformed growth because when growth does well, it does great, but when it rolls over, it's bloody. You know, if you remember, the tech wreck was 80-90%. I think even Amazon, which was a phenomenal business, their fundamentals, their sales and their earnings continued to increase through the tech wreck, but their valuation came down from some insane multiple, 200 times or whatever it happened to be, down to a more normalized multiple. While value took over from 2000 to 2006, their business continued to improve. The good businesses are going to continue to gain share, but the multiple were normalized, and I think we're on the cusp of that. And if you can see what's happened now, value minus growth, you had a very similar situation, you know, in 98 to 2000, where growth just took over, and we're kind of having the same situation in the last since 2017 to now, particularly, where it just falls off a cliff, and then all of a sudden value gets the rebound of all rebounds. And I think that's where we are. We had a similar thing in the early 90s, and if you notice, these are all near recessions. So we just had a recession. You had the same thing. You had a spike up after the 2008-2009 where value outperformed. In the 2000 to 2006, it was just a huge value outperformance. In 1990, right after the 1990-91 recession, value, so that's value had a nice run. So that's effectively where we are, value minus growth. But over the long term, you get that huge premium. You're at a point right now where you can really buy value at a if you're a mean reversion thinker, which is how we've always played the game. This is a historic point where you can't possibly get more bang for your buck taking that bet than where we are in terms of standard deviations out. So you know, many people are on TV talking about a barbell, and I think that's sensible to obviously not go too far over, but you don't have to get that much exposure to be overweight. The sector percentages of some of these have gone down so materially. You could be 100% overweight and not feel it, you know, by still having exposure to the general market. So the risk reward is just phenomenal here, and the value's there. And now we have the catalyst, and we have the business cycle timing, and we have everything behind us. This is just something we don't talk often about. I saw it in a Financial Times article. Is the yield curve 10-year to 3-month is also steepening materially in the fourth quarter, and that's continued after the election. So that's good to see. I'm more interested in the 10s to 2s, but this is also a good sign for banks, and that was the concept of this article. After the vaccine, U.S. banks in line for a windfall after COVID-19 vaccine progress, and they're saying basically what we've been saying for weeks is that they're going to be able. Obviously, the yield curve is steepening, and that they'll be able to release a lot of reserves because you know, this is coming to an end effectively. So very, very positive news on that front. Last week we went through all the bullish percent by sector. You can just take a look and see what happened to energy has really jumped up to 80% now on a bullish percent point and figure buy signal, which was good to see. And this is very common. So you had the original crash where it got down to 3.7% in March. then you get the rally, then you get a retest, and then you get a sustainable thing. You had the same thing in 2016, where you had the original crash, then a retest, and then you had a sustainable long-term trend. And the same thing in 2011 and 2012. You had the crash, and then a retest, and then a really sustainable long-term 3-4 year rally in energy from the retest was in mid-2012 all the way to mid-2015, early 2016 before it took a breather. So we're in the same position. Good to see that. Wells Fargo's out saying banks are the best economic comeback trade, tells clients to get aggressive. So opinion follows trend. Obviously, with banks up materially this week and most of them up double digits, now people are starting to get interested. They'll get a lot more interested when they start to break out to new highs. That's when you're going to see absolute euphoria. That's when we'll be laying off some of our shares. But for now, we're just getting started. That's basically what it comes down to. The only thing that can derail it in the short term is just bad political decisions with aggressive shutdowns. I think, that's probably a lower probability, and it'll probably be limited to certain states. So we'll keep our eye on that. But again, that's, months of bad decisions. That's not going to be years of bad decisions. So you may have to hold through a little chop. But the vaccine's coming. The treatments are here. It's really good news all around. Next, home builders, again, they continue. We've been talking about the secular trend, 85 million boomers. This is not stopping anytime soon. Rocket Mortgage, I believe their revenues were up 161%. They're one of the largest mortgage providers. That's going to trickle through. Obviously, Wells Fargo's in the top three. You're going to start to see it in future quarters' earnings as well. So that was nice to see on the home builder front. And now to our article.
Before we talk about tax-smart investing,
Louis Armstrong, what a wonderful world stock market. There's no better explanation for what happened on Monday with the vaccine and 90% efficacy. It's hard to convince someone to take a vaccine when you got, it's like the flu shot where you got a 50-50 shot of it working. But when you're at 90%, I think a lot of people are going to jump on board, and we're going to hit that herd immunity pretty quickly. So that was basically it. It flipped the switch from the tech market to the cyclicals and everything market. Again, it's not zero sum that, everything in tech is going to crash. It's nothing like that, although you are seeing some of the SaaS names really start to collapse. But Enfang took a breather in the last month, which we've talked about for many weeks. But I'm quite, all the facts point to we're going to get a significant period of outperformance for the value and cyclical names moving forward. And if you want to smile, play Louis Armstrong's song. It's just an absolute classic. So then we went through the Fox Business, and we went through the CGTN. Here's some more data on the China data. Domestic recovers first. China leads. This is their tourism. Air performance is back to pre-pandemic levels. We covered. Same in hotels. This spike here, they were actually higher than pre-pandemic levels. That was the National Day holiday in October. We don't have the November data yet, but it's probably in the neighborhood. Next is emerging markets earnings. That is being really led by Asia. Okay, back to pre-pandemic estimates, whereas Latin America portions and the Europe, Middle East, and Africa are lagging. So all of the quick recovery is in Asia, which we've covered. And so moving along, the next part of the article we covered, we've been making the case for many weeks that the catalyst for money to flow into the cyclicals, economically sensitive names would be a vaccine, and repeated over and over. And I would copy and paste it every single week. I remember this. I'm like, should I change this? I was like, no, let's not. Don't bet against science. And for those people who were betting against science, they really missed a huge opportunity. But as far as the left for dead sectors, this is just getting started. So they missed some, but if you look 2-3 years out, it's really just getting started. So last week you had a situation where Tech actually started to take the lead for a day or two, and everyone got really, really pessimistic on cyclicals again. And it was really hard to come out, I got to say, and conclude that article with the assertion, this is not the time to give up on the cyclical trade. And that was a very lonely thing, because a lot of the talking heads would go back on, go on TV and say, see, all these value guys, they're wrong again. This is a big fake out, blah, 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 load up into SaaS and tech. And this week, we had the trigger and stuck with the plan and were rewarded, and that's and that's just the beginning. So what a difference a week makes. This was from Tom Lee at Fundstrat, just showing how FANG started to weaken, and Epicenter, which is effectively cyclical, and reopening trade stocks. This was from Jerome Blockland over at Robico. Value versus growth, and this was up till Wednesday. This has now gone past that, so that was good to see. And these stock, I write this article on Wednesday night, so all of these that you're seeing, this is financials to NASDAQ. You're seeing they've just absolutely skyrocketed, and this is exactly what we were talking about in the article on October 29th before the election. We said that this market was setting up exactly like the 2016 election, that same weakness when everyone was panicking out and buy insurance. And we said, you don't buy insurance with the VIX at 30. That's the time to sell insurance and buy the market. And sure enough, we've got this exact outcome with the S&P 500 taking off, financials taking off, the yield curve steepening materially. That was the 10-year yield. Banks starting to rally. Energy starting to rally. XOM, we had Exxon there. We had defense stocks starting to rally. That's part of industrials. And General Dynamics. These were just some examples that we pointed to when we said this is looking a lot like 2016 in terms of the outcome. And we got it. And it didn't matter with the presidency. What mattered was we got divided government and we got resolution, and here we are. So financials to QQQ. So this looks a little bit better at the end of today, but the point is the same. This is defense stocks to NASDAQ off the charts. These are ratio charts. Energy to NASDAQ off the charts. And this was from Elena Popina. You could also follow her on Twitter. She's at Bloomberg. She said, so this was yesterday on Thursday when energy was having a weaker day. Despite yesterday's dip, energy stocks in the S&P 500 remain on track for their best week ever. There's no question that materialized as of today. They had a strong day today, and 16% for the week. So very good to see. We've been seeing crude draws pretty much every week since we put out this Rystad data on June 18th. If you recall, I was pounding the table on June 18th that we were having surpluses all year due to COVID, demand destruction, and I said that this what no one's paying attention to with this OPEC deal is that it's through April of 2022. They've never done a cut that lasted that long. And sure enough, right after that data was out, and I'll show you the chart we put out. This was on June 18th. You can go back and check it out at hedgefundtips.com. Just click on commentary or sentiment under categories, and you can pull up every article we've ever done, and podcast and videocast. And so this was it. This was it right here. That's when we put out the data and the expectation that we were going to move into draws. And that's exactly what we've had consistently ever since. And this is going to persist. We had a build this week on the EIA numbers. We had a draw on the API numbers. But in large part, this is going according to schedule. And energy is expected to get a continued bid due to the fact that it started at 9.7 million barrels a day, then it tapered to 7.7. It's supposed to go to 5.7 million barrels a day and stay there until April of 2022. Instead, it looks like they're going to keep it at 7.7 million barrels for an extra few months before tapering down to 5.7. So this could even become better and better and better. I think that OPEC is feeling a lot better now, and demand is going to pick up. So that is a good thing, and that was a good roadmap. And this is exactly it. So this was the end of June, and we've had effectively draws most of the time ever since, with the exception of a couple builds, and we got one this week as well. What's taking place now is an unwinding of excesses caused by unusual once-in-a-century circumstances. So this chart shows the and if you're listening to the podcast, you can just pull up this article to see these charts on hedgefundtips.com. Scroll down on the right side under popular articles and click on the one that says Louis Armstrong and has a picture of Louis Armstrong, and you can read all of these and see these charts. It's often helpful to visualize it. This shows the PE spread between the S&P 500 momentum versus value is at a high we haven't seen since we had that abrupt rotation in 2000, 2001, and commodities, value, cyclicals had their best 6 years in decades. I mean, it was just phenomenal period for that group, and I think we're on the precipice of the same thing. Again, I don't think the performance of value and cyclicals is going to come at the zero-sum expense of growth momentum tech stocks because they're good businesses, but I do think we'll see material relative outperformance because we're going to get a normalization of multiples, since the multiples expand when managers have nowhere else to go to buy growth. With the economy reopening and growth coming back and the delayed effect of $20 trillion of global fiscal and monetary policy solving a $3.6 trillion contraction in GDP, managers are going to want to pay less for the same or greater growth that is now available through value and cyclical stocks. Before, you could only buy it in a handful of stocks, and then a couple dozen sub stocks, the SaaS and some of those, and the stay-at-home stocks. But now the palette is wide. They have all the colors they want to paint a beautiful picture, and they can get that growth at much lower prices, and it's supply and demand. So if the supply is greater, the demand for the highest multiple stocks is going to go down a hair or more. And while their businesses will continue to do great and people will continue to zoom, they just might not be willing to pay 200 times sales. So, call them crazy. So next, okay, we covered the tailwinds of both the first 8 to 12 quarters of a new cycle and the 6 months after an election. The other thing is you just look at earnings. We put out this chart from FactSet. The green sectors are going to grow the fastest in 2021 at the same pace or faster than the S&P 500. Again, we've covered these: energy, industrials, discretionary materials, financials. And the ones that'll grow the slowest are consumer communication services, infotech, in the communication services at 15% relative to the S&P at 22%. Infotech pulled forward a lot of their earnings growth. They're going to grow at 14%, which is great, but the S&P is going to grow at 22%. Healthcare at 11%, staples at single digits, utilities, et cetera, et cetera. This was a picture of Santelli on Mike Santelli on CNBC, and he was putting out, I believe, a chart from Credit Suisse this week saying cyclical staging a comeback. S&P projected 2021 EPS growth, and he has it actually grouped by cyclicals at 66% earnings growth relative to the S&P at 21%. So that needs to be parsed, but the concept was the time is now. Post-election behavior. Okay, so yeah, similar to the setup is similar to what we saw in 2016, and that's now playing out. The key was not the presidency, but rather a divided government that keeps the corporate tax rate at 21%. And you can see what's happened since the election. S&P up big. This is obviously higher, by the way. Both the Russell and the S&P closed at new highs today. That's really, really constructive. Financials, again, boom, they just popped. 10-year yield popped. Wells Fargo popped. Bank of America popped to the upside. Energy sector popped to the upside. ExxonMobil. All the charts that we put anticipating before the election have followed the script, which, if they continue to follow script, means they've got a lot more upside in the short term. and meaningful upside for years to come. Defense sector off the charts. General Dynamics, Raytheon Technologies, all off the charts. So the other point was 3 weeks ago I made the case that people need to, quote, calm down like Taylor Swift, because while most people were calling the stock market a bubble, there were hundreds of stocks that looked nothing like a bubble. These are the same stocks that have rallied huge in the past week. And here's the article and the list. This was the Taylor Swift You Need to Calm Down stock market. Again, you can pull these up on hedgefundtips.com. So my question in that article was, so the heading was, but it's a bubble, exclamation point. And then I said, do these stocks look like a bubble? And there was a block of 24 24 stocks, then another 24. So about 100 stocks I posted. American Airlines, just random stocks, Anheuser-Busch Brewing, Bank of America, Credit Corp, Citibank, BP. These are the stocks that are just flying. Bausch, Canon, Carnival, CF Industries, Chimera, Colony, Chevron, another bank, Cisco. Cisco, by the way, ripped today, by the way. So yeah, that wasn't in a bubble either. That was up 6 or 7% today on earnings. CPA, that's a South American stock. Coty has been up big. ConocoPhillips. Every single one of these defense stocks up huge. I think that this DFEN is up 40% in the last few weeks. Discover Communications, that's the Discovery Channel. DK is a refiner, up huge. EOG up huge. ERX, the leveraged energy, up huge. FANG up. FANG, the Diamondback Energy. FAS is up. It was trading below 40. I think it's at 47 now. So that's probably up 30% in the last week or so. Fox A, which I talked about on the Claim and Countdown. The next day, Trump tweeted that he wanted to go to Newsmax or start a competing station. But Fox is a very resilient company. They've got a huge buyback, and it was back up today. $2 billion buyback authorized. They bought $500 million of stock at $35. You can buy it in the market now at $27. I think this one's got room to run. GE up huge. This thing was left for dead. It was at $7 when I put this out. It's now over $9. Someone raised the price target to $11 today. That's a levered play on the airline and vaccine. Gilead was in the low 50s. Now I think it's closed at 60. That's going to be a huge thing when they get the inhaled remdesivir that, basically you could get a script for it like you get it for a Z-Pack, and that'll be a game changer. So if you go out and you get COVID, you call your doctor, go to Walgreens, pick up your thing, or send someone, obviously, if you have COVID, and you inhale the thing for 3 days, and COVID's, cuts it in half from 13 days down to 4 or 5 days, and you're all better. That will be an absolute game changer, and we don't have a timeline on that, but that when it comes, I think that's going to be a big deal. Nordstrom, totally left for dead. That thing has been ripping this week. Kinder Morgan, Liberty Global, Lila, which is a South American version, Las Vegas Sands. Every single one of these stocks that was left for dead, they're all flying. Then we did another group. So you can just go through these and take a look. Royal Caribbean, PSXP, there was some big unusual activity in that. That's a midstream company, actually. Royal Dutch Shell has ripped higher. Raytheon, again, we've been talking about that for weeks. Six Flags ripped higher. Spirit Air is up like 50% in the last week. Schlumberger, Suncor, this whole list, just go through them. Exxon is starting to really rip. I think that's going to be a huge one, along with Wells Fargo. So go through it. Walgreens Boots is starting to fly. So that's that. Everyone was calling it a bubble, buying insurance, and I was saying, look, this is not when you want to buy insurance. If you look at this chart, this is near a bottom, not near a top. If you want to call a top, let's talk when the VIX is at 10, and then wait a year, and that's probably when you've got your top and things start to crash. Hit 10, wait a year, crash. Hit 10, wait a year, you have a crash. But volatility starts at 10. So we're not anywhere near that. And now people are saying, well, with the VIX getting below 20, that could be bullish. You think? So that is further good news. Okay, then we said the energy. Okay, so we made the case for energy. When was that? In the article on the I'm an Accountant article, which was October 15th, and you can see this long-term chart we posted. And extremes, largest short in energy in 20 years. Here's what happened next. And this was when we put that on October 15th. This has now jumped at least 20-25% since we put this out. Actually, probably more like 33% from these levels. But nonetheless, I think this is the beginning here, guys. This is a generational opportunity, and I think there have been no major investments in major projects for oil for the last 5 years. The rig count's down from 1,400 in December of 2014 to a few hundred now, less than 300. And demand is going to pick up very, very quickly, and there's going to be a real issue. And whether that's 6 months from now, 12 months from now, or 18 months from now, it doesn't matter. Market's discounting mechanism. It'll start to sniff that out just like it did in early 2000s and ripped higher till 2007, 2008. So here we are, and these things are starting to happen. So for those of you who have been with me for a few weeks or months and been patient here, now it's payday, and this is really, really exciting to see. Okay, now, then we also had, there's all of our good stuff. Then we also had the Cobra Kai leg sweep. If you remember that article, that was from, that was about Wells Fargo. I guess, let's see. So that must have been in late September. And then we ripped out of that, and then we took a huge detour. But remember, we said we knew what we owned. The fundamental thesis hasn't changed. It's trading at a 43% discount to book. It's only done that 2 other times in its history. It recovered in months, not years. Book value now is hovering around $40. It'll probably be higher once they take all these reserves down. And sure enough, while it took this crazy detour before the election, it's absolutely ripped off the bottom, about close to 20%, mid-teens. Now we're back over this line of demarcation. We're getting through this supply at volume by price. And the other thing in the long-term picture, which we've been covering, this ADX, which we rarely use, but it's worked so well 15 out of 16 times historically, that, here it dipped below just to make everyone puke, and now it's back above this line of demarcation, above the volume by price, and I think this thing can run, and this looks like it's going to recross, so we could potentially see one of these big reversals like we saw in 2016 or in 2011, and really get back up to new highs over the next couple of years, which would be really exciting to see. Nothing's changed on the fundamental thesis. You can go ahead and review that at the Stevie Wonder Faith stock market. We put that out earlier in about 2 months ago. We just showed the relative valuations. This is an update on the yield curve. It's following according to plan. The yield curve inverts, the market collapses. The yield curve inverts, the market collapses. The yield curve inverts, the market collapses. And then you get this huge steepening and the first pullback, and financials take off. You get this huge steepening and the first full pullback, and the financials take off. This red and white line is the 2 to 10 year yield, the steepening of the curve, first pullback, and we're taking off. So this should persist if history is any indicator, and the demand from the 85 million millennials is not going to subside soon. We saw it in the housing earnings. We saw it in the Rocket Mortgage earnings, and we're going to see it in the bank earnings moving forward, particularly the lenders that no one's paying attention to because they're all saying, let's go buy banks like Morgan Stanley and Goldman that have trading businesses, which is unpredictable revenue. They have investment banking business. It's lumpy revenue, and you can't model it out. The business is going to be the lenders, 85 million people starting housing formation, now more motivated than ever before. It's happening. This is going to be a secular trend, and this is going to be one of the key catalysts and commodities behind the roaring 20s decade that we have to look forward to. So barring some short-term volatility, dumb political decisions are made in the next 8 weeks. And then beyond that, it should be smooth sailing. So that's the story there. And then in August, we put out the Gordon Gekko Gridlock is Good. That proved to be true. On August 13th, we put that out. And the other thing we said about the banks here under this yield curve chart, the fundamentals have not changed, and that's why when you know what you own, you don't get shaken out from an erratic, quote, leg sweep from the Cobra Kai analogy. You simply add more from the folks who puked. They will be back to buy it from you in a number of months when it's breaking out to new highs, at which time we'll gladly lay off a bit to the giddy converts. Now, keep in mind, this is a very important thing because everyone thinks that their way is the best way, and it's just not the case. There's so many ways to the top of the mountain. So the people that are buying it from us in whatever it is, 6 or 12 or 15 months at new highs, they're going to make a lot of money too. And maybe in some sense that, they won't have to wait. They'll buy the breakout. The breakout will fail. If they hold on to it, they're going to make a ton of money over the next 3 to 5 years. If they puke out because they're just traders trading off of a technical thing and they don't know what they own, they'll miss that secular thing. So the breakout buyers are going to make plenty of money. But the opportunity here is to make 100% before the breakout, and benefit from this secular trend. And this is going to be a great thing. So both ways work: buying new highs and buying value. More than one way to the top of the mountain, but this is the way that we played the game. We like mean reversion. We like taking the long-term view, and we like loading up on weakness and then realizing fair value and then laying off over time. So. That's worked for us very well over the years, and that's that. That's the other thing you got to learn in this business is you have to know your personality and you have to know your trading style. One of the books that got me very excited in the business, when I was an undergrad at Columbia, I would sneak into the business school library at URIS, and I read Market Wizards, and there were all these different traders, and the common denominator is they all had separate strategies, and yet they were all extremely successful. Different time horizons. Some guys were intraday. Sometimes guys were 3 to 6 months. Some were 3 to 6 years. But they were all extremely successful, which is why they were in the book and in the subsequent books. So, I would just say be dogmatic about your own style because it works for you, but don't be dogmatic that nothing else works, because a lot of things, there are a lot of ways to make a lot of money. Just be kind and be open-minded with people out there. Everyone's doing their best. So, okay. So now for the week, this first chart, the sentiment survey results, this was a bit of an alarm. It hit 55%. This is as a contraindicator, a lot of bullishness coming in. The problem with this read is this has been a quirky survey for the last few months. I don't know if they've lost members and they're not getting as clean of a read, but it is something to keep an eye on. I do think for the general indices, this may be true. I think for the left for dead sectors that we're focused on that are now starting to rip, I think it's just getting started. So even if you have short-term volatility as sentiment comes back on the retail side, it's just an opportunity to load up. The fear and greed hit 66 when we wrote this, so that's still not at an extreme. It's probably closer to 70 or 80 at the close today. You can just go to Google CNN fear and greed, see where it is. If it's over 80, yeah, you may want to get a little cautious. But again, some of these stocks that are still down 30% on the year, and you take a 12 to 16 month outlook, it's time regardless. Active managers were underweight. So this is contrary. So the fear and greed was bullish. The AAII was cautious, bearish as a contraindicator. Fear and greed was like there's still room to run. And the managers are flat-footed again. They were buying insurance, as you can tell from the pricing, and they were selling equities, and they were de-risking, and they've missed this huge pop, and now they're going to have to chase into year end. So barring stupid political decisions, I think that you're going to see a chase into year end. Now, our final message for the week, if you've been with me for a long time, we've come a long way since we put out the Spanish flu article on March 19th, when everyone was panicking, again, buying insurance at the bottom and selling the market when they should have been selling insurance and buying the market. We put this out, which was an analog from the 1917 to 1918 Spanish flu. That correction was about 33%. We got about 35%. And sure enough, we bought them 3 days later. My general view is the easy money has been made in the general indices in the short term. I think we are going to have a roaring 20s. However, I think the easy money is just getting started in the left for dead sectors and stocks that we've been talking about. I believe banks, defense stocks, and pockets of energy will be as good, if not orders of magnitude better than buying the general market in late March. So if you feel you missed it, I think it's really just getting started. You just have to be selective and smart where you go, and patient, and being able to deal with the volatility. If something's up 16% in a week, if it takes a breather, you should be expecting that. If it dips back to 5%, they're not going to give you free money. What they like to do, everyone that jumped in on Monday that wasn't pre-positioned, of course they had to shake them out on Tuesday and Wednesday. They don't let you in for nothing. They take you up, and then they force a fake out to just puke out all the newbies, and then they're gun shy, and then you get a day like Friday, and they're like, oh, I missed it again. So maybe they chase it Monday, you get another shake. It's just the nature of how the market works. But the key catalyst, thinking long term, you got the vaccine and treatments now. Gridlock's good from a government standpoint. Trade and policy uncertainty should diminish. 5 to 6% plus GDP growth in 2021 from all the money supply increase, global and fiscal and monetary policy around the globe. You're going to see continued upward earnings revisions. Banks are going to play a huge role in that. Energy should start to help. And general pessimism is thawing as the unemployment rate drops. We'll have some bumpiness with these regional shutdowns in the coming weeks, the headline risk, but looking through that, it's going to be really phenomenal. And then the accommodative Fed, they're not going anyway. They're going to keep the short end pinned at 0 to 25. They're going to let the long end do what it does, and that's going to create a continued steepening and just facilitate huge profits for the banks. But more important than that is huge credit expansion in the economy, because banks will be incentivized to extend credit because they can make money on net interest margin, and that's where you get the long sustainable recovery. So time will tell, but in the meantime, we work hard, we work smart, we stay humble. No one has a perfect crystal ball, and we're flexible as opportunities abound in coming weeks. What a wonderful world. So that was our article of the week. And just wrapping up, we don't have a lot more. So if you get cut off on the podcast, you're probably not missing much. Utilities sector, we did. Their earnings were revised up by 1% in the last 60 days and 12 basis points. S&P 500 earnings were revised up again this week to a little over 168. Same sectors leading the way that we've discussed. And then as far as economic data, the core ones that we want to focus on here was small business optimism beat expectations. JOLTS, there's 6 million jobs available out there right now. We had the draw on the API. We had the build on the EIA for the energy. Continuing jobless claims beat expectations was 6.7 versus 6.9 million expectations. So that was good to see that continue to come down. Inflation was subdued, which means the Fed can keep their foot on the gas. Let's see, consumer expectations and consumer sentiment missed expectations. And I think that's just with the cases going up in the short term as these treatments get out there and the vaccine gets out there. We'll just deal with that headline risk day to day. But that's the long and short of it. I'll be on Cheddar TV on Monday morning at 9:30 a.m. if you want to tune in for that. Otherwise, we'll review it on next week's podcast. Thanks for tuning in. What a great week. Thanks for listening, and we'll be back next week, same time, same place. Make it a great one.